Most retirees focus on how much they make. The smart retirees focus on how much they keep. Today, I'm going to show you 3 tax strategies that can help you keep more of your retirement wealth. I'm Brad Lineberger, certified financial planner and founder of Seaside Wealth Management, helping you create peace around the issue of money. When people hear terms like Roth conversion, tax loss harvesting, and tax gain harvesting, they think that these are 3 separate strategies. But in today's video, I'm going to explain what each of them are, I'm going to show you how they can work together, and why proper coordination matters. I love Roth conversions because it's the process of taking money out of your traditional IRA and putting it into your Roth IRA. So every time you take $1 out of your traditional IRA, you're gonna pay taxes on that dollar in the year that you do the conversion. But once the money's over into your Roth IRA, now you can grow it. And as long as you're over the age of 59 and a half and the money's in there for at least 5 years, everything coming out of that Roth IRA is completely tax-free. Let me say that again. Take money out of your traditional IRA, pay taxes now, put it into your Roth IRA, and grow it tax-free forevermore. Couple things to consider. The best time to do the Roth conversion is when you find yourself in lower tax brackets. This might be a sabbatical from work, or you've been laid off, or could be early in retirement before your other income sources have been turned on. And I like to call these the gap years. And these are the years between when you retire and when required minimum distributions kick on at either 73 or 75. So required minimum distributions, this is the IRS forcing you to take money out of your traditional IRA or your 401k because Uncle Sam wants his tax dollars. And the older you get, the larger those required minimum distributions can be. In fact, I've seen people with $100,000 and more required minimum distributions, all because they did a good job of saving in their 401k while they're working. They let it defer, they let it grow, and now they're faced with these large tax bills later on in retirement. So strategic Roth conversions, when you find yourself in the lowest tax bracket, can really save you a lot of money over your lifetime. And not to mention, if you're to pass on investments to your kids or grandkids, anything coming to them in a traditional IRA, your kids are gonna have to take money out every single year over a 10-year period. And every time they take dollars out of your traditional IRA that they inherit, they're paying taxes most often at their peak income earning years. Whereas if you can shift that money over to a Roth IRA, now the kids inherit the Roth, and what we'd recommend is they should invest it aggressively. They don't have to take annual required minimum distributions. And if they can grow that Roth at 7% over a decade, that's enough to double the amount that they received upon your passing. In other words, let's say they inherit $500,000 at your passing. They grow it at 7%. 10 years later, it's now worth $1 million, and all of it comes out at the end of the 10th year tax-free. So Roth conversions, if done correctly, can really be a beautiful thing. Tax loss harvesting is the process of selling investments at a loss. Now, you're only going to do this in a taxable investment account. In other words, you're not doing this in your traditional IRA or your Roth IRA or any retirement account. It's your after-tax brokerage account. Why? Why would you sell something at a loss? Because you sell something at a loss, and those losses can be used in 2 ways to benefit you. The first way is you can lower your adjusted gross income every single year up to $3,000 per year until those losses are completely exhausted. So you can get some tax relief every single year until they're gone. And the second way is you can carry those losses forward into the future in perpetuity, and you can use them to sell things at a gain in the future, and those losses will help offset the gain. So essentially, you could sell things tax-free in the future, which I really like. So where that strategy comes into play is you carry the losses forward, you sell gains tax-free, and then you can take a distribution totally tax-free, which is gonna keep your income lower, which, by the way, in those low income years, that makes for a great year to consider that Roth conversion. So you can start to see how these strategies kind of play together and coordinate. But before I go there, you might be wondering, geez, Brad, you sell something at a loss. I thought you always say you want to buy low and sell high. And selling low, that seems a little bit counterintuitive. You're right. The proper way to tax loss harvest is like this. You sell a security at a loss and you need to replace it with a similar security so it will avoid the wash sale rule, but also will keep you invested in the market. Because we know that when markets go down, and they do, they typically come back fairly quickly. Not always, but markets historically have come back after declines. So you need to remain fully invested to participate in the recovery that historically has always happened. Now, avoiding the wash sale rule, that means if you were to sell an S&P 500 ETF, you cannot buy it back, the same investment, for 31 days. Otherwise, the IRS is going to disallow those losses. But if you bought something that was similar, but different enough to avoid the wash sale rule, you can stay fully invested, you can participate in the market recovery, and you can get the tax benefit as well. Tax gain harvesting, on the other hand, is the process of selling investments at a gain when you find yourself in low tax brackets. What I mean by that is, if you find yourself somewhere in the 10 or the 12% tax bracket, there's a very good chance that you're going to pay 0% in long-term capital gains taxes. So the tax code is really interesting. On earned income, ordinary income, we have a 7-bucket system. But on capital gains, we have a 3-bucket system, and it's more favorable. So all the way up almost to the top of the 12% tax bracket, you're gonna pay 0 in long-term capital gains. And then as your income starts to increase, you could pay 15% in capital gains or 20% for the highest income earners. But the strategy of tax gain harvesting is to use your low income years to sell investments in your taxable investment account and pay nothing in capital gains tax. I don't know about you, but I love tax-free. So this is going to require you to just pay careful attention each year to where you're at in the tax bracket. And if you find yourself in that 0% long-term capital gains bracket, then absolutely consider selling some of the gains in your taxable investment account, and you can live on those gains. And this is where the coordination of these strategies comes into play. If there's years where you're in 0% long-term capital gains, you sell your investments out of there and you use the proceeds to live on. So you're keeping yourself in a lower bracket by tactically doing this. In that low year, you then do a Roth conversion. And my favorite spot to do Roth conversions is up to the top of the 12% bracket. If you find yourself in the 10 or the 12% bracket, I'm pounding the table saying you should strongly consider doing a Roth conversion. Now, if you find yourself in the 22 or the 24% bracket, I think it's a bit of a gray area. I think there's more things to consider, like your lifetime tax bill and what your required minimum distributions are going to be. And if you start to sneak into the 32% or higher, probably not as exciting to do a conversion. But the coordination of these 3 strategies can really help you save a lot of money over your lifetime. So tax gain harvesting to keep yourself in low brackets while you're doing conversions, or you could do tax loss harvesting. So let's say 2022, the bear market, or the COVID pandemic 2020, if you had significant losses, you could realize those losses, allowing you to carry them forward into the future. So when your portfolio recovered, you use the losses to sell investments out of your taxable brokerage account, and that's what you're gonna live on to keep you in that lower tax bracket so that you can do Roth conversions all the way up to the top of the 12% bracket. So that's my favorite way to use these 3 seemingly independent strategies, work them together to really help lower that tax bill. And it's not just lowering it for today. What I've seen in my 20 years of doing this, I've seen people save hundreds and hundreds of thousands of dollars in taxes over their lifetime and actually pick up investment value because there's less tax drag on the back years where required minimum distributions get so high. And that's only the beginning. Then the amount of taxes that you can help your kids save, it's wild. I've seen families collectively save over $1 million in taxes, and they weren't rich or wealthy. They're average people who just followed good advice and they were using these types of strategies. They saved a lot of money on taxes, built wealth for themselves, built wealth for the next generation, and really put it together nicely. Taxes are going to be one of the top 2 expenses that you're going to pay for the rest of your life. At Seaside Wealth Management, we are passionate about helping people lower their lifetime tax bill and building wealth for generations. Use the link below to schedule a call with someone on my team, and we're happy to help you lower your tax bill. See you on the next one.